But we begin, as always, with three things investors ought to be thinking about right now. Stocks tumbled after hotter than expected inflation data and a dire warning from Morgan Stanley. Existing home sales continue to fall, but new home sales are surging. With mortgage rates still near their highs, what's the outlook for housing? And if you missed out on the bond rally, now you could have a second chance to jump in. On the Barron's Roundtable, my colleagues Andrew Bary, Carleton English, and Jack Hough. So, Jack, Ben takes off a week to go skiing, leaving you to explain the worst week in the market.
The heavy lifting.
Yeah.
Yeah. Third straight week of declines for stocks. Losses were really concentrated at the beginning and end of a 4-day week. On Tuesday, the S&P fell 2%. We got economic warnings from Home Depot and Walmart. And we had a report from Morgan Stanley that said that U.S. stocks have entered the death zone.
Ooh, that doesn't sound good.
One of my least favorite zones, really. I spoke with Mike Wilson. He's Morgan Stanley's chief investment officer. And death zone is a mountaineering metaphor, right? He says basically stock prices look too high relative to the yields that you can get now on bonds. He doesn't think bond yields are going to come down anytime soon. And he also thinks that earnings estimates are still way too high. So when you put it all together, he thinks that U.S. stocks could fall as much as 25% during the first half of this year before rebounding later in the year. Ouchie. And then on Friday, we got the Personal Consumption Expenditures Price Index. That's the Fed's preferred inflation measure, higher than expected. It actually rose a little bit. So whether or not you believe that stocks are in a death zone, consumers are stuck in this stickyflation district. That's not a mountaineering term there, Andrew.
It's a little scary because while at any given time in the market you can find a bear who can say death zone type things, Mike Wilson has been really prescient. So what does an investor do?
Well, Morgan Stanley says stick with defensive sectors, healthcare and staples. The firm actually has a fresh money buy list. It's kind of on the short side, but some of the names included there are Coca-Cola and Verizon. I also spoke this past week with Alistair Pinder, stock strategist at UBS, and he says dividend stocks look like a good deal here. The firm ran a screen for dividends, moderate dividend yields, plenty of potential for payment growth, and then combine that with some quality measures. The names that it found included Amgen, that one pays 3.6%, and Broadcom 3.2%.
Okay, cheer me up, Carleton. There's a silver lining in higher rates, which means savings accounts are suddenly yielding more than they have been for, 15 years?
Definitely. And I have to think back. I'm an 80s baby, and I remember when savings accounts were getting you 5%. We're not quite seeing that in savings accounts now, but we are seeing that in 6-month treasuries, which could be a good bet for income-oriented investors. Now, the one thing to keep in mind, though, is that's more of a cash management tool. It comes with some reinvestment risks. So you may want to look for some other options for, kind of cashing in, for lack of a better word, on this phenomenon.
Yeah, as Jack has pointed out, you might want, if you think a recession is coming, then you might want to go out to, say, a 10-year bond because those yields would probably come down. You've locked in the higher yield, get a little capital gain. Yeah,
and it always comes down to not just where you think the market's going, but your time horizon and your investment needs. That's certainly part of the calculus when you figure out what kind of bond situation makes the most sense for you. So again, the 6-month, very good as a cash management tool. If you do want to go further out, you could look at the 10-year. One key, though, pay attention to credit quality. It can be very enticing to get in on some of these high yield products, but they come with credit default risk.
1 and 2 years look pretty good, too. But speaking of default risk, talk about corporates. Do you want to go there? You get, an extra percentage point in return for a tiny bit of risk. But, high-grade corporates are a pretty good bet.
Yeah, high-grade corporates are another good bet. One thing you'd want to look at is something like the Vanguard short-term corporate bond ETF, yielding around 4.9% right now, duration of about 2.9 years. And you're looking at bonds in companies such as Bank of America, Apple, some pretty solid blue chip. You've heard of them. Yeah. They're not going to go bust anytime soon. So I think you're pretty safe there.
All righty. So now, Andrew, the third side maybe of these high rates is the housing market. It's really playing havoc there. Lots of cross currents. I think basically people want to know, is my house going to go up in value or down in value?
Well, that's tough to say. I mean, home sales are down for about 12 months in a row, and they're down about 30% year over year. Home prices, though, are holding up relatively well. They're down about 5% or so from the peak last year. But the market is actually holding up better than many people thought, given that mortgage rates have almost doubled to 6.25%.
And of course, home values really spiked during COVID, so maybe down 5% over a year, but still up right nicely over 2 or 3 years?
Yeah, it's still up nicely. It depends on the area of the country. I mean, one thing that continues to support the market is low inventories, particularly in affluent, desirable parts of the country, whether it be areas like Sarasota and Florida and some of the New York suburbs. It's hard to find homes in many of these areas.
Because somebody's locked in a 2 3/4 mortgage rate, they really don't want to go anywhere, right?
Yeah, I mean, that's basically preventing a lot of homes from coming on the market. People have 3% mortgages. They don't want to sell and have to basically get a 6% loan right now. So that's keeping inventories low, which is keeping prices relatively high.
We're going to talk more about that dynamic later.